All right, bank loan versus hard money loan versus debt service coverage ratio or DSCR loan. Which one's right for me? Well, I'm going to answer those questions for you right now. I'm Marc Santos. I'm with Rapid Fund Lending, and I fund real estate projects for real estate investors all across New England. And I want to talk about the three because there's a lot of questions I get from different borrowers about which one is right for them. And so I'm going to walk you through each of these three today and how and when you can consider each of them the appropriate tool at the appropriate time. All right. So first, just as a quick disclaimer, all of these options are for non-homeowner occupied loans. So these are for investment properties only. So something you're not going to be living in or ever intend to live in. All right. I want you to look at each as a potential solution for the right project or right type of project at the right time. And so what do we mean by that? When we talk about short-term loans versus long-term loans is the first thing we want to really clarify regarding which two of these tools might be right for you. So by short-term, what I mean is typically around 12 months, all right? That's the time that you may want to take a distressed property. It's going to take some time to rehab the property or build the property. And then stabilize the property. So by stabilize, we mean get it rented, leased up, so that you're generating consistent cash flow and income from the property over the long term. Okay, you're set up. So when you go to and then of course long-term loan is anything typically beyond that. We're talking about once a property is stabilized and rehabbed, you want a nice stable long-term loan or mortgage that you can rely on for, say, the next 20 or 30 years. Okay, so you can hold that property and generate cash flow from it. Okay, so there's the difference between short-term and long-term, how we want to define it. So when we talk about bank loans first, the way I like to look at it is for both short-term and long-term loans, bank loans can be your first option. Go explore it first because generally these are going to give you the best rates and the lowest cost over the longer term of that loan. However, that all said, it's going to take a long time to get a bank loan, typically 30 to 90 days to do a loan. You need to have strong credit, typically a stable property in a desirable area that the bank wants to lend in. And banks are generally going to just be the most conservative with their money out of these three options. So in general, if you have time to do the loan application, if you're well qualified, you've got great income, good tax return history, good track record and experience, good down payment and everything, bank loan may be a great option for you, especially for the long-term loans, okay? Those loans generally are like the 6 to 7% range on interest for commercial type loans. So they're going to be the lowest interest that you're going to pay. But again, banks typically don't want to lend on distressed properties or properties in rough areas or whatever it may be. And if you're self-employed or something of that nature and can't show income over your tax returns, you're probably not going to qualify for a bank loan. Okay, so bank loan, great option if you have all of those criteria, you have time, you have good income history, and you have the time to close the loan. Okay, so next is a hard money loan. Hard money loans are short-term in nature, so 12 months or less typically. It can vary a little bit. And it's property focused. So where these come in handy is for house flippers who don't necessarily have the best credit, or they just don't have the time to go through a bank loan because oftentimes a distressed property, the seller wants to sell quickly and sell it for cash with no appraisals required or anything like that, as in would be required with a bank loan. So a hard money loan is meant to be convenient, fast, and easy. Now for that, you're going to pay a premium. So interest rates with hard money loans range anywhere from say 9 to 15%, maybe even more with some lenders, okay? Short-term bridge transition loans, they're meant for you to be able to take that property, that distressed property, fix it up, repair it, build it, rehab it, and then stabilize it. So get it leased up, rented, leases signed, and generating income so that you can then transition it to a long-term loan. okay? So that's why they call hard money loans bridge loans or transition loans, those types of things, okay? Fast, convenient, easy, like I said. You're gonna pay higher interest rates, like we said, and typically it's up to 12 months. Now, the great thing is they typically don't have prepayment penalties. I know I don't. I want to incentivize you to get a project done as fast as you can because of the fact that a hard money loan is a bridge loan and it is more expensive. So we like to see our borrowers finish those projects quickly and easily, all right? So that's the intention of a hard money loan, okay? So I often get the question, well, Mark, why a hard money loan versus DSCR? Again, it really just, my first question is, well, is the property stabilized? Is it rehabbed? Is it ready to be financed for the long term? Okay. Hard money loans are meant to get that property from distressed to stable. Okay, and typically that's a short-term loan, so 12 months or less. Okay. Finally, DSCR loans, and this is the one loan that I get from borrowers that they just don't have a really strong understanding of it, and that's okay. It's a fairly new product, and this product exists because there's a need for it. Oftentimes, we'd run into borrowers who would take a hard money loan out to get a project done, and then couldn't refinance it on the back end because they were self-employed, or maybe they didn't have perfect credit, and now they're stuck having to sell a property that they really wanted to keep. So DSCR really fills that gap, that need for borrowers who can now hold a property for the long term after they've stabilized it and rehabbed it. So it's a great product, all right? So long term in nature, property focused, it's not borrower focused like a bank loan will do. So it's typically about 30 years in 30-year loan. There are some prepayment penalties if you do pay it off early, typically within the first 5 years. Typically, they'll go 70 to 80% loan to value on those loans when you either refinance them or purchase them, however you structure it. They're going to look at your credit, but it's not necessarily as important as with a bank loan. However, you're still going to need a credit score of about 660 or above, typically 680 or above, okay? There are no income requirements. This is where it really differs from a bank. So there's no income requirements, no W-2s, no tax returns. So this is great for people who are like self-employed and can't really show good income on their tax returns. Those people are automatically going to be disqualified for a bank loan, but they can qualify for a DSCR loan. So this is why this is such a good product for folks who are self-employed, real estate full-time, those types of things. Okay. They're also going to ask typically for cash reserves on the order of 6 to 12 months worth of cash reserves for your payment. So if your monthly principal and interest, taxes and insurance payment, mortgage payment is say $3,000 a month, they're going to want to see at least about $18,000 to $36,000 in a savings account or some type of bank account that's as a reserve for you. Okay. So those are some of the things. Now let's talk about the core of a DSCR loan. What does that even mean? So debt service coverage ratio is simply a ratio that bankers will look at to determine whether or not someone qualifies for a loan. So what is that? It's net operating income divided by the debt service payment on that. So in more simple terms, it's your gross rents on the property after it's stabilized divided by your mortgage payment. Okay, now your mortgage payment's typically going to include your principal and interest, and then your property taxes and insurance, all escrowed into it, like a typical mortgage is for your primary residence. Okay, so they want to see that number is at least 1, but more preferably like 1.2 to 1.3. If it's 1, there's a chance you might not qualify. If it's 1.2 or greater, generally you're going to be in good shape to qualify for that loan. Okay, so when you're planning out your projects, you should plan for that short-term transitional period where you're going to rehab it and stabilize it, and then plan for your long-term refinancing option. So that's why a hard money loan into a DSCR loan is a great, two great products for you to get a project from off the ground up to long-term stabilization so that you can hold it as a long-term asset in your portfolio. Okay, and again, bank loans can be your first option for either of these two, but just know that you're not always going to qualify, or they're not always going to be fast enough or easy enough for you to use them, and that's why hard money and DSCR loans exist. Okay. So with that said, let's talk about the 8 questions you should know when applying for any loan, whether it's a bank loan, a hard money loan, or a DSCR loan. My initial consults with folks, you can go so much more smoothly if you're prepared with this information. It can go very quickly, very smoothly, and it also shows me that you're prepared as a borrower for a conversation like this and that you know what you're doing. Okay, so number 1 is obviously the property type and address. Okay, so tell me where the property is. What type is it? Multifamily, single family, commercial, mixed use, whatever it may be. Okay, what's the as-is value right now, the realistic as-is value right now? Okay, so what's it going to sell for to an investor on the market right now in this market, and its as-is condition prior to it being rehabbed or built? Okay, so if we're talking new construction, that's the land value. All right. What are the current or expected monthly rents once you do have it rented out, if that's an appropriate need for the property? What is the requested loan amount? How much are you looking to borrow on the property? What's the after repair value or the resale value of the property once you've built it or done the rehab on it? Okay. What are your construction costs and your general scope of work? So how much total is it going to cost you to do the construction? At this stage, we don't necessarily need to hear every little detail that you're looking to do to the property, but just a general total cost of construction and just basic broad things you want to do. I need to replace a roof, put 2 new kitchens in, 2 new baths, vinyl side the exterior, new heating systems. That's all we really want to hear at this point, okay? And then total cost so that the numbers match up. Okay, finally, your credit score. And then lastly, what cash reserves do you have available to you? So those are the 8 top questions that you're going to get that I would love for you to be prepared for. And again, if you are, you're going to show your lender that you've got your stuff together, that you're organized, and that you're prepared to apply for this loan. So I hope this helps. Understanding the difference between bank loans, hard money loans, and DSCR loans. The great news is that we can service you for both hard money loans and DSCR loans. Okay, so if you have a need for either of those 2, give us a call, or come to our website, and we'll help you from there. All right, have a great day.